Please help me understand when to exit a call option. I have the Tesla October 2023 $175 call, which I plan to sell when the trend flips. That's exactly what you do. But if it just keeps going up, how close to expiration would you sell? So this is from Artsy1. Again, love it. All these newcomers buying calls for the first time and killing it. So first of all, for those who don't have call options, what this does, it gives you the right to buy 100 shares per contract of Tesla at $175 per share. If you look at the cost right now, you're $85 in the money on this strike, but there's not that much time left. October is 3-4 months away. So what you can do is you can sell it before expiration, and also you can sell it on a spike, which jacks the call premium because of volatility, which goes into the ingredients of how these things are priced. So wait for a spike to do that. Or you can sell an out-of-the-money call against your call if you have the options authority in your account to do that. So let's look at where we could be by October. And again, I do believe it's a bit of a big range, but we've seen how AI stocks can just explode. And I do believe Tesla's the leading AI stock. So your kind of 95 price of your call option today and where it could go and what it could be worth is as follows. So I see the Tesla range somewhere by October being $230 to $350. Yes, it's a big range, but it's also an interesting time. Typically, the markets can fall in September or August for a number of reasons. And I do believe that could be a buying opportunity or a dip, not necessarily driven by the trend, but by the macro. Now, if we do go all the way to 350, you can see your contract here be worth over $8,000. And of course, if it goes down to 230, I see that as the bottom end of the range. You will still be well in the money from where we are today. The price today, the zero, is kind of if you sold today, what you would get versus the gain of holding. And I do believe the probability of us going higher from here by October is higher than us going lower. But we could dip to 230. And that's based on kind of layer out model numbers that I have. So how I play it, my strategy has always been you buy long-term call options to build a bag, and then you use that bag to do stuff. Let me explain. So I use long-term options, first of all, to speculate on price. I typically go in very hard when prices, I believe, are way out of the norm, and I do believe they'll mean revert. Then I convert them to equity for my growing bag. And then I use the equity as margin to sell puts on dips. And I use equity as margin to sell calls on spikes. Or I use the actual share itself. But I tend to love selling puts as much as possible. But if I'm doing a large number of contracts, I need a lot of margin. And that's what I use as my kind of my nest egg. And also, it's kind of a long-term hodl position that generates perpetual cash. That's my whole strategy. So that's what I would do. Don't look to getting out of an asset, as we discovered earlier, that could go very high as these numbers here. You know, the worst thing is regret. You know, I remember people with Amazon, over 20 years ago, or Apple, or Netflix. They sold too early, and they ruled the day for years. And every year after, they see it going up and up, and I was like, oh my God, imagine if I had my 1,000 shares, that would have cost me a couple of $1,000s, be worth millions now. So that's the danger. Don't sell pristine assets. Milk them this way as much as you can. So that's the magic money secret today.